So today we're doing a presentation based on Marriott Corp case study. Next slide, please. We're gonna look deep into the company overview, financial strategies, cost of capital, WACC analysis, and some questions to think of. Marriott Corporation was founded by John Willard Marriott in 1927. As time went by, it separated into Marriott International and Host Marriott Corporation in 1993. Marriott International is the largest hotel chain in the world by number of available rooms. However, with the coronavirus situation recently, the company is facing a lot of challenges. They are having a revenue loss of $234 million in Q2 of 2020, and the company reported a profit of $232 million for the same period, as the previous year. With the comparison, we can see the company is having a lot of loss right now. So those are the three main lines of business. They are lodging, contract services, and restaurants. Lodging has been the most profitable line. It generated 41% of sales and 51% of profits in 1987. And for contract services, it generated 46% of sales and 33% of profits. Restaurants provided 13% of sales and 16% of profits. Next slide, please. Now let's look at the financial strategy and financial strategy they have back in the time, and are they consistent with its growth objective? So the first key element of Marriott's financial strategy is manage rather than own hotel assets. This is kind of smart for Marriott to manage than rather to own, and it is consistent with its growth strategy, because having a partnership with others can actually help Marriott to save more on tax and decrease the potential risk losses. Since they could share risks with their partners in this way, Marriott is more likely to attract additional capital through this strategy, which means they will be able to put more investment and also invest in projects that increase shareholder value. This is also consistent with the growth. This strategy increases Marriott's shareholders' value. According to the NPV criteria, a positive NPV of projects will increase the shareholders' value. Next slide, please.
So the third strategy we have is optimize the use of debt in the capital structure. And then this is consistent with its growth objectives as well. Generally speaking, optimal capital structure should always bring a higher shareholders' value. Additionally, it provides a good way to control default risk by aiming at a certain coverage ratio. And then the last strategy we have is repurchase undervalued shares, which is not consistent with its growth objective. It could actually result in a lower growth since the company will use free funds to buy back the shares. The company may have made bad investments, which led to losses. As a result, the price of shares has gone down. Under this situation, Marriott shares may become overpriced because of the repurchasing of the undervalued shares. Next, please. So the question we have right now is, how does Marriott use its estimate for its cost of capital, and how does it make sense? So Marriott is using the weighted average cost of capital, which is WACC, approach to value potential investments. WACC is the required return on the investment that the company expects to pay all the investors that finance the company assets. The formula is above. And then in this formula, we can see that tau is corporate tax rate, D is market value of debt, E is market value of equity, RD is a pre-tax cost of debt, RE is after-tax cost of equity, and then V is value of the firm. To figure out the cost of capital, a company needs some data on debt capacity, debt cost, and equity cost. The way Marriott uses estimate of its cost of capital is pretty simple. And the company has three divisions: the lodging, contract services, and the restaurants. Each division requires its estimate to the cost of capital and it requires separate data on all three inputs. Marriott cannot assume the identical cost of capital required for all the divisions because each sector will have its unique risk and opportunities. So it annually monitors and updates the cost of capital for each division. Moreover, Marriott has a specific hurdle rate for each division to properly calculate the cost of capital required to stay profitable on the investment and then reduce the risk of having negative NPV on the project. Next, please.
So now we have the weighted average cost of capital. So as we just mentioned, we're going to go over not only the weighted average cost of capital for Marriott as a whole, but also doing that same weighted average cost of capital for the individual divisions too. So just briefly, we have outlined the different weighted average cost of capital for the divisions. So for lodging, we have 15.5%. Contract services, we have 9.4%. And then for restaurants, we have 11.2%. And then we're going to go into a little bit more depth in these next slides and how we got to these equations and answers. So for lodging, one of the important things to notice, especially with the weighted average cost of capital, is going to be figuring out the risk-free rate for both these two things over here, which is going to be the return of equity and the return of debt. So because lodging is financed through long-term debt, we use the 8.72% as the 10-year interest rate that was found on Table B within this study, within this case study. And then we're going to use that for both of these equations. And then moving on to beta, something important to keep in mind is that we have two different, kinds of beta. We have unleveraged, and then we re-leverage that beta before we adding it into WACC. And the reason for that, so under leveraged beta shows the volatility of returns without financial leverage. So otherwise, just simply the asset beta for that specific asset class. Essentially, with WACC, under leveraging is necessary, especially in this scenario, mainly to account for the varying debt and capital structures within each business division. So once we found our unleveraged beta, this is going to be the average unleveraged beta for all the different individual assets within this class of lodging. We go on to the re-leveraged beta. So the re-leveraged beta, essentially, this now takes into consideration the capital obligations for each of the business divisions. So kind of bringing in that capital allocation and capital structure back into the beta. And then when we get all of those outputs, we simply just put them into our WACC equation, and then for lodging, we get 15.5%. So for restaurants, and then in the later slide for contract services, one thing to keep in mind as well is that these are short-term debt financed. So we use the 6.9% on Table B for the 1 year with this asset class because it's financed through short-term debt. And then using the same logic as the previous slide, we get our answers for beta unleveraged, beta re-leveraged, return equity, return on debt, and then the ultimate gives us a WACC of 11.17%. And then moving on to contract services, one thing that was interesting about the contract services that our group found is that the beta was not, given to us, or the unleveraged or leveraged beta to begin with wasn't given for us for this division. So essentially, we had to get the weighted average. So like we see in our equation for the beta portfolio. So the beta portfolio is just going to be the beta of Marriott as a whole. And then each individual beta is going to be representative through weighted average, so we can get the full one. So essentially, when we got our weights, we use identifiable assets, which can be found in Exhibit 2 of our case study. So when taking the weighted average for each restaurant, lodging and contract services, we got 27%, 61%, and then 12% respectively. And then when we insert those weights and the previously found betas in the last couple of slides into this equation over here, we then isolate for beta C and then get the beta of 1.5 or 1.6 for the beta for C. And then with the same logic as last time, we find our return on equity, we find the return of debt, and then insert those into our WACC for contract services to get 9.4%.
So I'm going to talk about the questions to think of. And one of the question is, what type of investment would you value using WACC? So when we look at WACC, we look at 3 different divisions, which is lodging, contract services, and related business. And we should consider the lowest WACC of for the investment because it will yield the highest NPV and highest profits. We should also not forget about investments to issue more bonds and get a cheaper financing. So they definitely should be considered. So whenever Marriott chooses a project to invest in each of 3 divisions, of course, they pick WACC separately for each division because of different risks and potentials. But what they do is they pick the lowest one because it will yield the highest return. The question is, the second question we consider is if Marriott used a single corporate hurdle rate for evaluating investment opportunities in each of its lines of business, what would happen to the company over time? So the general question is, what would happen to the company if they used one hurdle rate for all of the divisions? So what it means is that using a hurdle rate for all of the investments would not lead to a pleasant outcome, of course, for several reasons. One of them is that Marriott has, as we said before, 3 different divisions that operate based on different risks and factors. Hurdle rate is a minimum acceptable rate of return required on any given project. So if the hurdle rate is too high, the project might end up being unprofitable and yield actually negative NPV and bring less positive cash flow into the company. So the general rule is the higher the risk of the project, the greater the hurdle rate is. So if we apply the same risk potential in all 3 divisions, it will cause fluctuation in cash flows and impact the growth of the company, as we said before. It will also hurt, if Marriott overestimates the risk, it will hurt even more the growth of the company because the cash flows into the company, the cash inflows will actually decrease over time. So let's take an example. For example, imagine we have 2 contract services, one contract services group and one lodging group investing into 2 different projects. So the cost of capital for the lodging services is at 8% and the cost of capital for contract services is at 12%. So Marriott decides to use a general hurdle rate for both of the investments and they use a 10% back for that. So if the hurdle rate is at 10%, and based on that, Marriott will not invest in the lodging project because the lodging project cost of capital is 8%, and instead they would put money into the contract services project as its cost of capital is 12%, which is greater than the hurdle rate, which means that there's a 2% profit that Marriott will get from this project in the long term. However, we would never know if the lodging project would actually be negative NPV. So what I'm trying to say is that if we use one general hurdle rate for all of the projects in all 3 divisions, it will actually result in rejecting positive NPV projects and accepting negative NPV projects, which would definitely hurt the company in the long run and in the short term. So let's go to the next slide and we can look at the Marriott as a whole and divisions. We have several ratios on the slide. One of them is talking about the ROE, ROD, and the WACC. So if you look at ROE, it's definitely visible that Marriott is doing a great job in most of the three divisions on creating a greatest return on equity. So the investors should be definitely happy with that, especially because lodging is the greatest part of the profit and the biggest part of from all three divisions in Marriott. So 19% return on that is pretty huge for investors, and I'm definitely sure that they're quite happy with the result they're seeing, especially with restaurants and contract services, which usually will be lower because it's not as big as lodging and restaurants in Marriott. Also, WAC, as we could see before, it's different in all three divisions and in whole Marriott. It depends on the risk and potentials in each division and each sphere. That's why they calculate it differently, and we generally agree with that strategy. In conclusion, we would like to talk about the hurdle rate recommendations, which is how Marriott should take on their projects in the future. So for lodging, we would recommend lowering the hurdle rate as it would yield even greater returns. And for restaurants, we would recommend to not change anything in hurdle rate. And from contract services, we would like to suggest to increase the hurdle rate for the investments in the future for any future projects.